So, Murray Limited is preparing to set up business on the 1st of the 1st, 2014 to manufacture a single product. Below is the sales budget for the company for the first 6 months of 2014. So you've got your sales units and sales revenue there. Number 1, each product unit requires 5 kgs of material X, which costs €2 per kg. 2. Stocks of finished goods are maintained at 70% of the following month's sales requirement. 3. Stocks of raw materials sufficient for 20% of the following month's requirements in kgs are held at the end of each month. 4. The cash collection pattern from sales is expected to be: cash customers, 40% of sales revenue will be for immediate cash. Credit customers, 60% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. Note 5. 1 month's credit is received from suppliers. Note 6. Expenses of the business will be settled as follows. Expected costs. Wages, €25,000 per month, payable as incurred. Variable overheads, €5 per unit, payable as incurred. Fixed overheads, including depreciation, €30,000 per month, payable as incurred. Capital costs. Equipment will be purchased in January costing €45,000, which will have a useful life of 5 years. To finance this purchase, a loan of €30,000 will be secured at 10% per annum. Interest to be paid monthly, but capital loan repayments will not commence until July 2014. Required: A. Prepare a production budget for the 4 months January to April 2014. B. Prepare a raw materials purchase budget in units and in euros for the 4 months January to April 2014. C. Prepare a cash budget for the 4 months January to April 2014. D. Prepare a budgeted trading and profit and loss account for the 4 months ending 30th of the 4th, 2014, if the budgeted cost of a unit of finished goods is €25. E. Part 1. What useful information is available to Murray Limited from the completed cash budget? And then 2. Explain what is meant by a capital budget. So Part A. Prepare a production budget for the 4 months January to April 2014. So the information that we want to look at here is the sales in units. So January, February, March, April, May, June is there, the information is there, but we won't need it all. But note 2 is important there. Stocks of finished goods are maintained at 70% of the following month's sales requirement. So we will look at January, February, March, April and May, and we look at May because we're going to need to know what is the closing stock for April. So we throw in the sales in units for every month there from the question, and then we're going to start adding closing stock. So note 2 again, stocks of finished goods are maintained at 70% of the following month's sales requirements. So 8,000 multiplied by 70% is 5,600. That is the closing stock in January, and then therefore it is the opening stock then in February. And we're taking away the opening stock because we do not need to produce that stock then. Okay, because that stock, if you can imagine it, is already in the warehouse. So then March, 10,000 multiplied by 70% is going to be the closing stock then in February. So February's closing stock is going to be the opening stock then in March. Then April, €9,000 multiplied by 70% is 6,300 closing stock. And then that is going to be the opening stock then for April. So minus 6,300 here. Then May, 10,400 multiplied by 70% is going to be April's closing stock, which is going to be May's opening stock. And then you'll get 7,700, which is June, 11,000 multiplied by 70%, 7,700 there. And we'll just do that to get May's figures because we'll need it for part B. So in total, required for production then, January, 12,600 units, February, 9,400 units, March, 9,300 units, April 10,050 units, and May 10,850 units. So then part B, prepare a raw materials purchases budget in units and in euros for the 4 months January to April 2014. So how many kgs of materials do we need to purchase based on the units that we have calculated in part A, and then how much is it going to cost us? So the information that we're going to use is contained in part 1 and part 3. So part 1, each product unit requires 5 kgs of material X, which costs €2 per kg. So we have got those required units from part A, and then we have multiplied that then by 5 kgs, because each unit requires 5 kgs of material X. So required for production, then you're just going to multiply them all by 5 kgs. Now, note 3 says stocks of finished goods sufficient for 20% of the following month's requirements in kgs are held at the end of each month. So 47,000 multiplied by 20% is 9,400 closing stock in January, which is going to be the opening stock then in February. So 9,400 is opening stock there. March, 46,500 multiplied by 20% is 9,300 closing stock, which is going to be the opening stock then in March. April's 50,250 kgs, when I multiply that by 20%, that is what they want to have March at the end of the year, 10,050. And then the opening stock is there for 10,050 kgs, then that is the opening stock for April. May's 54,250 kgs that they need, multiply that by 20%, because that's going to be the closing stock then in April. So that is 10,850 kgs. So required for purchase altogether then, January you have 72,400 kgs, February you have 46,900 kgs, March you have 47,250 kgs, and April you have 51,50 kgs. Then we need to multiply that by the price per kg, which they tell us in part 1 is €2. So multiply that all by €2, and then you get the cost of raw materials. So January 144,800, February 93,800, March 94,500, and April 102,100. So that is part 2 complete, the raw materials purchases budget. Part C then asks us to prepare a cash budget for the 4 months January to April 2014. So just like every other cash budget that we have done so far, you're going to be looking at the sales revenue that they intend to get from January through to, now you only have to do to April, but you're going to look for the cash collection pattern from sales. So when are we going to receive the cash from these sales that are up here? So cash customers, 40% is going to be for immediate cash. 60% of sales revenue will be from credit customers. These debtors will pay their bills 50% in the month after sale and the remainder in the second month after sale. So the credit sales 1 month, you're going to have the 60% credit sales is going to be split up half and half between 1 month after and 2 months after. So it's going to look like 40%, 30% and 30%. So 210,000 multiplied by 40% is 84,000. 210,000 multiplied by 30% is 63,000 and 63,000. So you're going to receive 84,000 in January, 63,000 in February and 63,000 in March of January's 210 sales. Then February, 240,000 multiplied by 40% is 96,000. 240,000 multiplied by 30% is 72,000 and 72,000. Then March, 300,000 multiplied by 40% is 120,000. And then 300,000 multiplied by 30 is 90,000. Then in April, April's 270,000 multiplied by 40% is 108,000. So tot up all of the receipts there. You've got 84,000 in January, 159 in February, March is 255,000 and April is 270,000. So next then, note 5, it says to us 1 month's credit is received from suppliers. So we look back at our part B, so our raw materials purchases budget, and so what we purchase in January, we're going to pay for it in February, so that's 144,800 to be paid in February. In March, we're going to pay for what we bought in February, so that was 93,800. In April, we're going to pay for what we purchased in March, which was 94,500. Then we have wages, 25,000 per month payable as incurred, so 25,000 there in each month. Then variable overheads, €5 per unit payable as incurred. So you go back to part A where you have produced the units. So that they are the units that you intend to produce. So it's going to be €5 per unit payable as incurred. So 12,600 by €5, 63,000 in January. February, 9,400 units multiplied by €5 is 47,000. March, 9,300 multiplied by €5 is 46,500. And April, 10,050 multiplied by €5 is 50,250. Now, next we have the fixed overheads, including depreciation, €30,000 per month payable as incurred. Now, as you know from doing the previous cash budgets, you know that depreciation is a non-cash item. So there is no transfer of cash when we're dealing with depreciation. So what we have to do here is we have to figure out how much the depreciation is, and we need to take it out of the 30,000 fixed overheads per month, because we only want cash items in this cash budget. So we look for the fixed asset, and it is down below. We have equipment that's going to be purchased costing €45,000. That's going to have a useful life of 5 years. So 45,000 divided by 60 months is €750 depreciation per month. So therefore the fixed overheads without the depreciation is 29,250 when you take the €750 depreciation out of it. Next, you have the equipment is 45,000. So 45,000, and then no other equipment was purchased then for the other 3 months. Then you have interest. So to finance the purchase of the equipment, a loan of 30,000 was secured at 10% per annum. So that is €3,000 there, okay? And when you divide that by 12, you're going to get €250. Interest to be paid monthly, but capital loan repayments will not start until after this period. So €250 in each month there. You tot up your payments, and then to get your net cash, you go total receipts minus total payments. So in January, 84,000 minus 162,500 is minus 78,500. February's 159,000 total receipts minus the total payments 246,300 is equal to minus 87,300. March's 255,000 minus 194,800 is equal to net cash of 60,200, and April's total receipts 270,000 minus total payments 199,250 is equal to net cash 70,750. Now we got the bank loan in January, €30,000, no other loan then for the other months. Then the opening balance in January was 0, so closing cash balance minus 48,500. So the closing cash balance minus 48,500 is the opening cash balance of the next month. So minus 87,300 minus 48,500 is equal to minus 135,800. That is going to be the opening cash then for March, so minus 135,800. Plus 60,200 is equal to minus 75,600. That is going to be the opening balance then in April, minus 75,600. So 70,750 minus 75,600 is equal to minus 4,850. So part D then of this question, Prepare a budgeted trading and profit and loss account for the 4 months ending 30th of the 4th, 2014. If the budgeted cost of a unit of finished goods is €25. Now, so budgeting profit and loss account for the 4 months ended 31st of the 10th, 2012. So remember, we're only looking at the sales for January, February, March and April. So when we tot up those sales, we get 1,020,000. There is no opening stock in this question. Our purchases come from our raw materials purchase budget in part B, so the 4 months worth of purchases there. Then we minus the closing stock of finished goods. Now, how did I get this 183,750? Well, in the question it told me that a unit of finished goods was €25. And I'm going to multiply that by 7350. Where did I get 7350? Well, that came from part A, which is my closing stock of finished goods, okay, in October. So 7350 multiplied by 25, and the RM is the raw materials, 21,700. How did I get that? Well, it was 10,850 closing stock of raw materials, so closing kilos, multiplied by €2 that each kg costs. So that is minus 205,450. So that is the cost of sales, 229,750. So gross profit, 790,250. Then we take away the expenses. So the expenses are wages, 25,000 by 4 months, which is 100,000. Then I have the variable overheads, so 63,000 and 47 and 46,500 and 50,250 is 206,750. Fixed overheads, 29,250 multiplied by 4 months is 117,000. Depreciation, €750 multiplied by 4 months is 3,000. Then we can take away the interest, €250 by 4 months is 1,000, and our net profit then is €362,500. So that is the budgeted trading profit and loss account. So part E and the theory part then. Part 1. What useful information is available to Murray Limited from the completed cash budget? And part 2. Explain what is meant by a capital budget. So, what useful information is available to Murray Limited from the completed cash budget? So, Murray Limited will be able to see in which months there will be a deficit of cash, which will enable it to make arrangements for a loan or overdraft. It will see which months will have a surplus of cash and will be able to arrange short-term investments. There was a surplus of cash in March and April. The trend of cash shortages is getting smaller, which is normal for new businesses, so they usually have a lot of cash shortages in the first few months. We always have deficits. Overdraft facilities will be required each month up to a maximum of €135,800 in any month. Closing cash shortage is €4,850. And then the next part of the theory is explain what is meant by a capital budget. So the capital budget deals with planned capital expenditure. For example, the purchase of a fixed asset, and planned capital receipts, for example, the sale of a fixed asset. So decisions regarding capital items are the responsibility of the board of directors. Carrying out of the capital budget is the responsibility of the financial